To open our chapter on advanced reversal candlestick patterns, let's begin with a valuable perspective from David Paul about the real role of a trader in the market.
Our job is to find an edge in markets. All you need is one pattern. That's all. You just need one pattern to be successful. The head and shoulders pattern could be your pattern. He put a chart up of lots and lots and lots of patterns. I love my wedges, falling wedges and rising wedges. I'm very fond of my fib levels and harmonic patterns, which are my own personal edge in both the stock market and in the forex market. But you need one little pattern. You need to practice really, really good money management, and that just means not losing any more than 1% of your loot, or at the very most 2% of your loot on any one trade. And then the third thing is to build the discipline to just do it over and over and over again.
That mindset, responding to what the market actually does instead of trying to predict it, is essential as we move into one of the most strategic chapters of our course, Technical Analysis for Day Traders, from basics to advanced. Today, we're diving into advanced reversal candlestick patterns, tools that offer deeper insight into market sentiment and help refine your trading decisions. If you've been following along, you already understand the structure and function of basic candlestick patterns like pin bars, dojis, hammers, and the Morobozu. These were key to identifying trend reversals and continuations. Now, let's start by talking about reversal patterns. These patterns are absolutely essential in technical analysis because they can signal potential changes in the current market trend. Whether the market is in an uptrend, consistently moving higher, or in a downtrend, steadily falling, reverse patterns serve as early indicators that the prevailing momentum might be weakening. This shift could mean that buyers or sellers are losing control, and the market may be preparing to change direction or experience pullbacks and corrections within the existing trend. However, it's important to recognize that reversal patterns can appear multiple times within a single trend due to natural pullbacks and deeper corrections, as we discussed in our video on market structure. Attempting to trade these patterns with the expectation of reversing the entire trend is a significant mistake. Therefore, traders should utilize reversal patterns for setting short-term targets and avoid anticipating that they will alter the main trend. Please keep this in mind as we discuss how to trade each pattern throughout this video. By using these patterns for short-term targets, you can better manage your trades without risking a full trend reversal expectation. This proactive approach can be especially valuable when identifying reversal patterns early. For example, if you're in an uptrend and a reversal pattern forms, it could alert you that the market may soon turn bearish, providing a timely signal to either exit a position or prepare for a potential short trade. Conversely, in a downtrend, recognizing a reversal pattern can signal that the sellers are losing strength and that buyers are starting to regain control, offering a chance to enter a long position as the market prepares to rise. Understanding these signals in both bullish and bearish trends is crucial for timing your trades effectively. But recognizing patterns manually can be time-consuming and prone to error, which is why having the right tools is essential. This is where technology plays a vital role in enhancing your analysis, to help you identify these patterns quickly and efficiently. As part of our practical approach using TradingView, one highly effective tool we recommend is the All Candlestick Patterns Indicator. This feature, which we're showcasing in this video, automatically highlights key candlestick formations on your chart, making it much easier to identify important signals as they appear in real time. While the indicator isn't perfect and may not always detect every candlestick pattern, it is an excellent tool for beginner traders to train their eyes in recognizing candle formations. A great feature of this indicator is its customization options. You can adjust the settings to choose which specific candlestick patterns you want to focus on, allowing you to tailor it to your particular trading strategy. For most of the examples presented throughout this lesson, we are using a Bitcoin versus US dollar chart on the TradingView platform. By including the All Candlestick Patterns indicator on this chart, you gain a clearer and more organized visual representation of how these reversal patterns actually form. This setup allows you to better understand their structure and behavior in a real trading context, helping you refine your decisions and identify opportunities with greater precision and confidence. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Now let's dive into our first pattern, the bullish engulfing. Structurally, this pattern occurs when a green candle completely engulfs the previous red candle. The psychology behind it is simple. After a period of selling, the buyers regain control with strong momentum, potentially leading to a bullish reversal. So, how do we trade this pattern? The most effective approach is to wait for confirmation. Typically, you'd look for the price to break above the high of the engulfing candle before entering a long position. This confirms that the buying pressure is likely to continue and reduces the risk of a false signal. Next, we have the bearish engulfing pattern. This is essentially the opposite of the bullish engulfing. It forms when a red candle fully engulfs the prior green candle, indicating that sellers have regained control after a period of buying, and a bearish reversal could be on the way. So how do we trade a bearish engulfing? Similar to the bullish version, you'd want to wait for confirmation. In this case, entering a short position below the low of the engulfing candle is the most prudent strategy. This ensures that the sellers have fully taken over and helps avoid getting caught in a premature entry. Next, let's move on to Harami patterns. These patterns, unlike engulfing patterns, show a smaller candle within the body of the previous larger candle, which indicates a potential pause or reversal in the market. First, we have the bullish Harami. Structurally, this pattern appears when a small green candle forms entirely within the body of the preceding red candle. The psychology behind this pattern is a clear sign that the sellers are losing momentum after a period of downward pressure. The appearance of a small bullish candle suggests that buyers might be stepping in, but with some caution. Now, how do we trade a bullish Harami? The key is to wait for confirmation. Typically, you want to see the next candle close higher, signaling that the buyers are indeed gaining control and the trend is ready to reverse. Only then should you consider entering a long position. On the flip side, we have the bearish Harami. This pattern forms when a small red candle appears inside the body of the prior green candle. It suggests that the buyers are losing strength after a period of upward movement, and the sellers may be preparing to take over. So, how do we trade a bearish Harami? Similar to the bullish version, we need to wait for confirmation. A prudent approach is to enter a short position after a candle closes below the Harami pattern, indicating that sellers are likely to dominate and push the market lower. Next up is the dark cloud cover pattern. This is a bearish reversal signal that appears at the top of an uptrend, giving us a clue that sellers might be preparing to take control. Structurally, the pattern forms when a red candle opens above the close of the previous green candle, but closes below the midpoint of that green candle's body. The psychology behind this is important. It signals that buyers initially tried to push the price higher, but were quickly met with selling pressure, leading to a strong rejection of higher prices. This rejection indicates that the momentum is shifting in favor of the sellers. How do we trade the dark cloud cover? The key here is to wait for a confirmation of continued bearish momentum. Typically, you'd want to see the next candle close lower, reinforcing the idea that sellers are firmly in control. Once this happens, entering a short position becomes a safer move, as the probability of a downward continuation increases. Now, let's shift our focus to a bullish reversal pattern known as the piercing pattern. This pattern typically appears at the bottom of a downtrend and serves as a signal that buyers may be stepping in to reverse the downward movement. Structurally, the piercing pattern forms when a green candle opens below the previous red candle's close, but closes above the midpoint of that red candle. The psychology here reflects a rejection of lower prices by buyers, showing that the selling pressure is weakening and momentum is starting to shift in favor of the bulls. So how do we trade this pattern? As always, confirmation is crucial. You should wait for the next candle to close above the high of the piercing candle, confirming that buyers have gained control. Once this happens, a long position can be considered, as the likelihood of a bullish reversal is significantly higher. Next, let's dive into the morning star pattern, another strong bullish reversal signal. This pattern typically appears at the bottom of a downtrend and signals that the market might be preparing for a shift from bearish to bullish momentum. Structurally, the morning star is a three-candle pattern. It starts with a large red candle indicating continued selling pressure. The second candle is a small body candle, which could be a doji or spinning top, signaling indecision and a potential pause in the downward movement. The third candle is a strong green candle that closes well above the midpoint of the first red candle, indicating that buyers have regained control. The psychology behind this pattern is clear. After sustained selling pressure, the appearance of a small candle shows that sellers are losing strength, and the third candle confirms that buyers are stepping in with confidence. How do we trade the morning star? You should wait for confirmation on the third candle, ideally by seeing it close above the midpoint of the first red candle. Once confirmed, a long position can be considered, as the momentum is likely shifting in favor of the bulls. Now, let's explore the evening star, a bearish reversal pattern that typically appears at the top of an uptrend, signaling that the market might be preparing for a shift from bullish to bearish momentum. Structurally, the evening star is also a three-candle pattern. It starts with a large green candle reflecting strong buying pressure. The second candle is a small-bodied one, showing indecision in the market. This could be a doji or spinning top. Finally, the third candle is a strong red candle that closes well below the midpoint of the first green candle, indicating that sellers are starting to dominate. The psychology behind this pattern is that after a period of aggressive buying, the second candle shows hesitation from buyers, and the third candle confirms that sellers are taking control, pushing the market lower. So how do we trade the evening star? Similar to the morning star, it's important to wait for confirmation on the third candle. Once the third candle closes below the midpoint of the first green candle, you can consider entering a short position, as the sellers are likely to push the market further down. Next, let's discuss tweezer tops, another key reversal pattern typically signaling the end of an uptrend and a potential shift toward a bearish trend. Structurally, the tweezer top consists of two consecutive candles with similar highs, which indicates strong resistance at a particular price level. The first candle is typically a green candle representing bullish momentum, followed by a red candle that shows sellers stepping in and pushing the price back down to the previous high. The psychology behind this pattern suggests that buyers have tried to push the price higher but failed at the same resistance level twice, indicating that the bulls are losing strength and the sellers are gaining control. How do we trade the tweezer top? The best approach is to wait for confirmation of the reversal. This typically happens when the price closes below the low of the second candle. Once confirmed, you can consider entering a short position, as the likelihood of a downward movement increases. Let's turn our attention to the tweezer bottom pattern, a bullish reversal signal that usually appears at the bottom of a downtrend. Structurally, the tweezer bottom consists of two consecutive candles with similar lows. The first candle is usually a red one, indicating continued selling pressure, followed by a green candle that shows buyers stepping in and pushing the price back up to the previous low. This pattern suggests that a strong support level has been established. The psychology behind this pattern indicates that sellers tried to push the price lower but failed twice at the same support level. This failure to break the support shows that the selling pressure is weakening and that buyers are gaining strength, signaling a potential upward reversal. How do we trade the tweezer bottom? The key is to wait for confirmation of a bullish reversal. This usually occurs when the price closes above the high of the second candle. Once this happens, you can consider entering a long position, as the probability of an upward move increases. Now let's dive into the three white soldiers, a powerful bullish reversal pattern that typically signals a strong shift in market momentum from bearish to bullish. Structurally, the three white soldiers pattern consists of three consecutive green candles, each closing higher than the previous one. The bodies of these candles are usually long, with minimal wicks, indicating consistent buying pressure and little resistance from sellers. This progression suggests that buyers are firmly in control, steadily pushing the price upward. The psychology behind this pattern reflects growing confidence among buyers after a period of downtrend or consolidation. The appearance of these three candles shows that bullish sentiment is gaining strength and sellers are losing their grip. How do we trade the three white soldiers? A common strategy is to wait for a pullback after the third candle, as this can provide a better entry point. The idea is to capitalize on a temporary dip before the upward trend continues, ensuring you enter the trade with reduced risk. Let's now explore the three black crows pattern, a strong bearish reversal signal that typically appears after an uptrend or a consolidation period. Structurally, the three black crows consist of three consecutive red candles, each closing lower than the previous one. The bodies of these candles are usually long, with small or no wicks, indicating that selling pressure is consistent and buyers are struggling to push the price back up. This pattern shows that sellers are in control and are steadily driving the market downward. The psychology behind this pattern reflects sustained selling pressure after a period of bullish momentum. The appearance of three consecutive bearish candles suggests that market sentiment has shifted, with sellers firmly taking over. How do we trade the three black crows? A common approach is to wait for a slight upward correction or pullback after the third candle. This pullback provides an opportunity to enter a short position at a more favorable price, while still capitalizing on the downward momentum. Next up is the abandoned baby pattern, which is a rare but highly reliable reversal signal appearing at both the top of an uptrend or the bottom of a downtrend. Structurally, the abandoned baby consists of three candles. The key feature of this pattern is the middle candle, which is a doji. This means the open and close are nearly identical, indicating indecision in the market. This doji is isolated by gaps on both sides. The first gap appears between the first candle, a large green or red candle, and the doji. And the second gap forms between the doji and the third candle, which moves strongly in the opposite direction of the first candle. The psychology behind this pattern is a sharp shift in market sentiment. After a strong move in one direction, the doji signals indecision, and the gap on the third candle confirms that the market has completely reversed course. Sellers or buyers have essentially abandoned their position, leading to an abrupt change. How do we trade the abandoned baby? The strategy here is to enter a trade in the direction of the third candle, which moves opposite to the prior trend. This confirmation of the reversal provides a solid entry point, as the shift in sentiment is often followed by a strong move in the new direction. Now let's look at the kicking pattern, which is a dramatic reversal signal that often indicates a sharp change in market momentum. Structurally, the kicking pattern consists of two consecutive Marubozu candles with a gap between them. A Marubozu is a candle with no wicks, meaning that the price opened at one end and closed at the other, showing strong and decisive momentum. In the case of the kicking pattern, the first Marubozu can be either bullish or bearish, followed by a gap and the opposite Marubozu, one bullish and one bearish, indicating a sharp reversal. The psychology behind this pattern is that the market experiences a sudden and forceful shift in sentiment. For example, if the first candle is bullish, it shows that buyers are in complete control. However, the gap, followed by a bearish Marubozu, demonstrates that sellers have taken over just as forcefully, leading to a strong reversal. How do we trade the kicking pattern? The key is to follow the direction of the second Marubozu. This second candle confirms the new trend, whether it's bullish or bearish. Entering a trade in the direction of the second Marubozu allows you to capitalize on the sharp momentum shift. Next, let's discuss the Harami cross, a pattern that signals a potential pause or reversal after a strong price movement. Structurally, the Harami cross consists of two candles. The first candle is a large one, either bullish or bearish, followed by a doji, where the open and close prices are nearly identical. What's key here is that the doji is completely contained within the body of the previous candle, indicating that the market is in a state of indecision after the strong movement in the first candle. The psychology behind this pattern is clear. The market is experiencing a moment of hesitation after a strong push in one direction. The appearance of the doji suggests that neither buyers nor sellers have full control anymore. This indecision creates uncertainty about the future direction of the trend. How do we trade the Harami cross? The most prudent approach is to wait for confirmation before entering a trade. You need to observe the next candle to see whether the market breaks in the direction of the previous trend or reverses course. Once the confirmation occurs, you can make a more informed trading decision based on the new momentum. In conclusion, we've now wrapped up our deep dive into advanced reversal candlestick patterns. By now, you should have a solid understanding of how these patterns can help you spot key moments when the market is about to change direction. From bullish and bearish engulfing to the powerful 3 white soldiers and 3 black crows, these formations offer essential insights to sharpen your trading strategy. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Calm Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Calm Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.